and I'm a host for many of our tax webinars here at Cherry Bekaert. Delighted today to have Deb Walker, our National Director of Compensation and Benefits Planning, to talk to us about what's new for end of 2019 and rolling into 2020. What can be done to be ready for 2020? It's hard to believe we're heading to the next decade pretty quickly. So today, Deb's going to talk about new healthcare programs that are possible, an update on some Tax Cuts and Jobs Act provisions. We're going to talk about some unique ways to work with some preferred retirement savings. We'll look at things that the IRS is engaged in to watch out for dealing with the IRS, and then a question that frequently comes up for us as to whether partners can be treated as employees. So with that, Deb, I'll go ahead and turn it over to you to get started talking about what's new in healthcare programs.
Thanks, Sarah. And this is really pretty exciting, and it's got an interesting history. We're going to talk about health reimbursement arrangements, and those have been around for almost 20 years. In fact, they started with corporate America because corporate America just decided to start paying employees health expenses up to a certain level, and that the reimbursements, because they were for health expenses, they were not subject to income or employment taxes. There are 4 different kinds of arrangements. I'm going to try and switch off my speakerphone and see if that helps the echo. Okay. There are 4 different kinds of arrangements: HRAs, qualified small employer HRAs, individual coverage HRAs, and expected benefit HRAs. Now, why did we end up with so many of these different kinds of HRAs? As I said, employers actually created these, and then IRS came out with some guidance to tell you how these could work. When ACA passed in 2010, they restricted the use of HRAs. The tax law restricted the use of HRAs through some guidance issued by the Obama administration, because that administration was concerned that employers would transfer high health risk employees out of their employers' group health plans and into the individual marketplace. And that would drive up the cost of individual insurance, even though the group plans were not, and maintain a lower cost of the group plans because they got their high risk employees out. So they restricted the use of that through some notices and questions and answers. IRS did that administratively. Then everybody got upset. Everybody got upset because the way the rules were written, you had situations in which perhaps you had a small employer, a church comes to mind, that employed a secretary and a janitor. And they had always paid these people's health benefits, except now the health benefits could not be paid without incurring excise tax of $100 a day, up to, so that would be $36,500 a year for each day that they covered these people in an individual health insurance policy. So Congress then enacted QSEHRAs. So now we have QSEHRAs, Qualified Small Employer Health Reimbursement Arrangements. And then when the current administration came in, they wanted to loosen up the provisions even more. And in doing through executive order and then through guidance released by the IRS, they've now changed the regulations to, in fact, allow for reimbursement of individual coverage and reimbursement of expected benefits. So let's start with the HRA and the rules that apply to that. An HRA can only be offered to employees under a group health plan. And that rule came out in 2013, as I said, to prevent people from using an HRA to reimburse a high health risk employee for individual coverage. Because if you had to only reimburse people that were in your group health plan, that meant your high-risk person was in the group health plan and therefore was not going to go to the exchange and drive up the cost of individual insurance. Lots of complaints. And in fact, one of the people that really sort of won out in all of this was 2% S-Corp shareholders, because IRS came out with a rule for 2% S-Corp shareholders that said, until we tell you otherwise, this rule on not being able to, being required to be covered by a group health plan doesn't apply to a more than 2% S-Corp shareholder. And because S-Corp shareholders are treated as partners, I think we can also assume that this rule, which doesn't limit HRAs, can also be used by partners. And even though the amounts have to be included in these 2% S-Corp shareholders or partners' income, even if paid by the employee, it's not going to be taxed for FICA or Medicare by the employee, and then the individual gets a deduction on their Form 1040 if they don't have subsidized health insurance available to them from the employer of a spouse or a dependent. So the partner and more than 2% S-Corp shareholder is going to be in the same place at the end of the day, as long as he or she doesn't have subsidized health care insurance available from the employer or the employer of a spouse or dependent. So now let's move on to QSEHRA, which came in to specifically help small employers. So the rule for QSEHRA is that you have to have less than 50 full-time or full-time equivalent employees. So it's the employers that aren't subject to the employer mandate. You must not offer a group health insurance policy to your workers, and this is what sometimes hurts people, you have to provide it to all full-time workers under the same terms and conditions. That employee that's going to get reimbursed under a QSEHRA has to acquire health insurance that provides minimum essential coverage. The reimbursements are limited to a certain dollar amount. These dollar amounts are increased for cost of living every year. These are the 2019 dollar amounts. The reimbursement, to the extent you get reimbursed, then the availability of going to the marketplace and getting a premium tax credit for purchasing an individual health insurance policy at the marketplace is reduced dollar for dollar. And, of course, the employers have to tell the employees that this benefit exists, so they take advantage of it. A lot of people didn't like this rule. So in the current administration, we changed the rules that said you had to be covered under a group health plan. This rule is going to be effective January 1st, 2020. It's called an individual coverage HRA. And you can enroll in health coverage now in order to have the required coverage by January 1. You still do have to have health insurance coverage in order to get reimbursed. And there is annual notification of benefits and certification of insurance coverage for reimbursement. So some of the rules that people don't like about this, one of the things that they said in the QSEHRA is you have to cover everybody. Here they said, okay, you don't have to cover everybody, but you have to offer it to one or more of 11 permitted classes of employees. And the permitted classes of employees, you can see them on the screen now: salaried, part-time, hourly, seasonal, a combination thereof. And they also constrained the type of insurance that can be reimbursed. So you have to have insurance for the month in which you're going to get reimbursed. And then there's a minimum size of this class. If we look on the next slide, you can see that the minimum size classes are 10 employees if the employer has fewer than 100 employees, 10%. So in one case I was working on, we only had 5 part-time employees. So we couldn't set up a class. We couldn't use the individual coverage because our class wasn't big enough. So in that example, what we did was go back and use a qualified small employer HRA. So the place you're going to see individual coverage HRAs used is by large employers who want to make sure that they cover 95%, they're coming close to the required 95% coverage, and they want to get some people out of the test so that they can still meet the 95% coverage and not have a violation. This does satisfy the employer mandate, and it's affordable if the remaining amount that the employee pays is less than 9.78% of household income. Again, this is a cost of living number. That's 2020. I'm sorry. And I think let's talk about the accepted benefits now. The accepted benefit HRA was also new with this administration because they changed the rules, and certain types of health insurance aren't subject to ACA. So if you're not subject to ACA, why don't we just let you be reimbursed tax-free for those benefits? And so that's called an accepted benefit HRA. So you can reimburse the cost of COBRA, dental, vision plans, and what they call short-term limited duration insurance. That does not include group health insurance or group health plans. These are short-term plans when you're not when you're out of insurance for just a little while. The maximum amount that can be reimbursed is $1,800, and that again is effective 1/1/2020. So to the extent you haven't been providing health insurance benefits to your employees, and you think and you're interested in providing tax-preferred health and benefits to employees, now is a good time to go back and see if, in fact, you can provide a QSEHRA, which you could have done for the past few years, or if the individual coverage HRA can work for you, or if the accepted benefit can work for you, or perhaps you're an S-Corp and you want to do this for the more than 2% S-Corp shareholders or a partner. So there's an evolution of this health reimbursement arrangements, and hopefully it will provide tax-preferred health benefits to a number of employees in the future.
Great. Thank you, Deb. Let's stop here. And Chrissy, let's have our first polling attendance question, if you can bring up that poll. Great. So if you guys are still here paying attention, please click on the poll to record your attendance. And Deb, so right now you've been having some conversations with employers looking towards 2020 and thinking about some of these benefits. I imagine open enrollment season may be going on in the midst of for a lot of companies now. Is this something that could be started in the middle of the year, or is it something that could be planned to start with the next plan year?
Well, what people are doing now usually is starting 1/1/20, and that gives them time to get the plan document in place, to have an employee meeting to explain it to everybody, to let people go out and make sure they have, in the case of QSEHRA, minimum essential coverage, and even in the case of the individual coverage HRA, there are provisions that allow for coverage now in order to be ready for 1/1/20.
Okay, great. All right. Chrissy, I think we're ready to close that poll. And so Deb, that's great news about more flexibility with health reimbursement arrangements. Let's talk about some unpleasantness, things happening in the Tax Cuts and Jobs Act and some provision updates we've had recently.
Well, this is, I would say, very unpleasant, and there's a lot of complaints. But this is a new code section. It's a new excise tax, and it has been explained by the IRS in Notice 2019-09. But it's an excise tax for 21% on payments to the 5 most highly compensated employees in the current year or any year after 2016. Now, for most of you that know anything about 4960, you might be saying, no. This 21% is only an excise tax for tax-exempt entities, and I'm a corporation, so I don't need to worry about this. Well, not so, because to the extent that you're a related corporation, it could be that payments that a taxable corporation pays to an individual who is also an employee of a tax-exempt entity that's related is going to be subject to this excise tax. So let me explain the excise tax, and then we can talk a little bit about, once you learn how bad this is, if you will, and if you have a for-profit entity where you have perhaps executives that maybe do a little work for a private foundation, that you could be having an issue. So the excise tax is imposed on severance pay for involuntary termination. That's good news. It's only involuntary. But to the extent severance pay is more than 3 times the individual's average annual compensation for the last 5 years. So you have to go back and see how much somebody was paid for the last 5 years, then take an average, then multiply that times 3, and if severance pay is in excess of 3 times, then it's subject to the excise tax of 21%. Also, if compensation is more than $1 million, it's subject to the excise tax of 21%. So that's where people are concerned that perhaps the tax-exempt entity doesn't pay this individual the $1 million, but perhaps a related corporation, because the amounts can be paid not just by the not-for-profit entity, but it can be paid by any related corporation. However, you must be an employee, or said a different way, you must render services to the tax-exempt entity to have to fall into this bracket. So there are a lot of people that are distancing the corporation from the not-for-profit entity in order to avoid the excise tax. Now, the 5 individuals, the next 2 lines are sort of, the next 2 bullets are kind of interesting, because you're going to find out the 5 most highly compensated people this year. And guess what? Once you become a highly compensated, you're always considered a highly compensated. So as people move into the highly compensated group, nobody's going to fall out. So you have a lot of tracking that you have to do to keep wondering if these people are going to get this severance pay for involuntary termination, or perhaps compensation in excess of $1 million. Now, the other big problem that's being caused by this code section is the fact that the tax applies at vesting. It doesn't apply at payment. It would be so easy if we could just look at somebody's W-2, because people are going to be taxed when they're paid, not at vesting. And yet for this tax, we have to look at vesting and not at payment. So there's lots of complaints about this. Although the IRS did give us a very good grandfather, because amounts vested before 2018 are considered paid, so you don't have to worry about them. The excise tax is imposed when amounts are vested as opposed to at payment. And of course, any payment that's made that's not subject to a vesting schedule is going to be deemed vested when paid. So what are we going to do to avoid this excise tax? First of all, you have to see if there are any employees of the corporation or also employees or former employees of the not-for-profit. And as I said, rendering services, I'm not even interested in how much you make, but if you're rendering services, then as a common law employee, then perhaps you're not going to, then perhaps you have to include all your compensation from the related entity. So what some people are doing is getting those highly compensated people at the related entity away from any activity with the not-for-profit. The next bullet point says, and this is probably much less practical, but can you change your organizational structure so that you somehow aren't related to the not-for-profit, the corporation that's paying, for-profit corporation that's paying high salaries, bonuses, stock plans, is not related to the not-for-profit. And then this is also, some of these planning ideas are going to be hard to accomplish, but can you modify your payment at severance, and then, but you have to be very careful you don't violate the 409 Cap-A rules as you modify the tax payment, the payments for severance pay. And the same thing with, can you reschedule vesting to limit it to less than $1 million a year? So vesting, you don't really have to worry about 409 Cap-A. Payment, you have to worry about. So there may be some other planning devices you can take. I think a lot of people are waiting for some regulatory changes. And so this may also be one that, even though that get out of the excise tax for now, and then when we have future regulatory changes, we may be able to reform again and get back into where it's not so onerous.
Hey, Deb, we've had a couple of questions come in here related to shareholders. So first off, if you're a more than 2% shareholder of an S corporation that's related to this nonprofit organization, I'd be interested in the nonprofit relationship between there, because you can only have, you're limited in who can be a shareholder of an S corporation. But does this help us in this regard if that 2% shareholder is not considered an employee, or might they still be because of their position and role as president or CFO of the S corporation?
So if a more than 2% shareholder who is an employee of the S corporation and also rendering services for and an employee of the private foundation, that's usually where you see these things, that could be an issue, because they would be considered related. It's not only stock ownership, it's, board of directors and things like that. So you're right, we have to look at the facts and see exactly, are we related? But very possibly you are related in that fact.
All right, great.
The one other thing we ought to talk about, avoiding this excise tax, because there's certainly a lot of insurance agents talking about it, because if you enter into a split dollar life insurance arrangements, now these are arrangements where there is a contract between the employer and the employee, and that contract directs the purchase of a life insurance policy, and the benefits and the cost of those life insurance policies are dictated by the split dollar life insurance contract or arrangement between the employer and the employee. So if the employee owns the policy, then premiums paid by the employer are treated as a loan, as if the employer gave the employee a loan and the employee bought the policy. Then, when the policy pays out, either at death or through withdrawals or sometimes at termination of employment, all of this is dictated by the split dollar life insurance arrangement. When that happens, it gets repaid to the employer. Now, if there's no interest expense paid, then the interest expense is compensation, but that's a much lower number. And in fact, some people even pay interest, so they avoid all compensation. Of course, I said we're going to split the benefits, the owner of the policy. If the employer owns the policy, then it's the value of the death benefit and other benefits that are taxed as compensation. What insurance agents are saying is that you can replace existing retirement arrangements with a split dollar life insurance arrangement. That's very factual. And in fact, in some cases, I think it could work, but you have to be very careful that you don't fall within the substitution rule for purposes of 409 Cap-A. Usually, the way you don't fall within that substitution rule is that you have a SERP that's not subject to 409 Cap-A, perhaps because it's a short-term deferral or something. But I think before I entered into any of these split dollar life insurance arrangements, which has very rigid rules since the early 2000s, to the extent I'm replacing an existing arrangement, I would look at it closely to be sure I haven't violated 409 Cap A.
And that SERP you're referring to is a supplemental executive retirement plan that is an unfunded, unqualified, non-qualified plan? Okay.
Right, that many tax exempt and taxable entities have, but yes. Okay, now we get to one of our favorite disallowed deductions for employer parking. The first rule, and I think this has been pretty well known, is that pre-tax salary reductions don't avoid this rule. When it first was passed into law, a lot of people read the statute incorrectly, but if somebody reduces their salary and says, employer, pay for my parking, don't give me cash, that is, in fact, qualified transportation fringes and subject to the disallowed deduction rules. And the after-tax salary reduction is, in fact, a way that you would avoid the qualified transportation fringe classification and thereby avoid these rules. One of the things that's really tricky about these rules is that it's the value of the parking that is not taxable to the employee, but it's the employer's costs that are not deductible. So the value, while you may think that the value of the parking is nominal, there is almost assuredly some cost. So now the IRS has come out with some rules on how you figure out what is the cost of providing parking to employee. And the example that
before we run into that example, let's go ahead and have our next polling question and give people a chance to catch their breath before we bring in the bad news about employee parking. So Chrissy, can you launch that second poll for us? There we go. All right. There's our second poll. If you will mark if you're there attending. So Deb, you've had a lot of conversations with companies about employer parking, isn't that right?
Yeah, so this is one of the next thing we're going to talk about is something that really doesn't have a resolution yet. And interestingly enough, I think advisors are sort of all over the place. I mean, there's a yes or no answer, so you can find advisors on both sides. But in our
just another 10 seconds or so to mark their attendance, and then we'll go on to that example, which I think is really quite helpful to work through. All right,
So the example, think about a law firm that's in a suburban location and it's in a 7-story office building, and the law firm has one half of one floor. And attached to this office building is a parking garage, which anybody can park in, although there's not much around except this 7-story building. They don't charge for parking. They don't mark any spots. They basically don't do anything with this parking. So the question is, and this employer which has one half of one of 7 floors, does the law firm let their employees park there for free? And the question is that employer provided parking? So the rule that the IRS issued on how you calculate employer provided parking said that if more than 50% of the parking is available to the general public, then there's no parking that's provided by the employer just for employees, and you don't have to have any disallowed deduction. So the question becomes, what happens with the other 7.5 floors, which are accounting firms and engineering firms and architectural firms and other law firms? All those employees are parking there. Are those people, the professionals that work in those other offices, are they considered general public, or are they somehow because they're employees of other tenants, they're not the general public? And I think certainly the way the guidance is now issued, you can include them in the general public, and our law firm would not have any disallowed deductions. The others don't agree with me on that, and but I think for a lot of people they do until we have guidance that tells us otherwise. So what happens when you have these disallowed deductions? Basically, for both moving expenses and parking costs, which are now disallowed deductions, then you have to make those payments taxable as compensation to the employee. And the easiest way to do that is to pay an allowance. So it's taxable as compensation. You're not reimbursing for any expenses, and the employer isn't making any payments. The next thing I want to talk about is an employee deferral election. This occurs when you're issuing options or stock in settling a restricted stock unit. Then employees getting that can defer their tax for up to 5 years. This is designed for smaller, high-tech firms who don't have cash to pay their employees, but want to give their employees options or stock because that's going to increase in value and taxed at a lower rate. So 80% of your employees have to receive it. You have to tell them the notice of the election. And by the way, this doesn't apply to a lot of highly compensated employees. So a lot of people would say, well, if they'd let this apply to the CEO and the CFO, then people might adopt this. Well, it doesn't. This is really for middle managers and rank and file employees. However, because people were concerned that they might have to apply this rule, the IRS has written a notice that says that stock has to be held in escrow until the taxes are paid, and the employer has to set up an escrow account. So if the employer doesn't set up an escrow account, then this provision doesn't apply. Then nobody has to worry about providing this required notice to say that the provision applies. So this is a code section I haven't heard anybody say they're going to use it because they only want tax deferrals if it can go to also the highly compensated. But let's move on to tax-preferred retirement savings, because this is something I really like. Somebody called and wanted to set up, actually they wanted to give retirement savings to rank and file employees after they'd been there 5 years. So they wanted to promise to pay a fairly large sum of money, say $5,000 once you've been there 5 years, $10,000 once you've been there 10 years, $15,000 once you've been there 15 years. And they wanted to do this on every 5 years. And they wanted it not to be taxable until the individual retired or reached age 60 or 65. So that plan, what they wanted to do, doesn't work under ERISA, because if you have rank and file employees, you have to fund a retirement plan. And if you fund it in a trust such that it can only be accessed by the employees when it's supposed to be paid, then it's going to be taxable. So how did we do this? Well, what we did was set up two plans, one for non-highly compensated employees and another for highly compensated employees. And we had to tweak a little bit. We had to give people a little bit of money every year. And we gave them lots of money every fifth year. And then we put in a vesting schedule. So even though the money was going in, if you didn't vest in the money, you wouldn't be paid. And then, of course, we didn't pay out anything until age 60. So by using the vesting schedule and really the age 60 distribution period, we were getting close to what the client wanted to do. And we had to pay $100 every year, but then we could make big contributions every fifth year. So the point here is you can use and this will pass discrimination rules. The reason it passes discrimination rules is everybody here is non-highly compensated. So we need to think sometimes about using qualified plans to provide a deduction up front, no income to employees, and in this case, an incentive for employees to keep on working, even though sometimes the jobs could be tough. They're kind of looking down the road to say, well, I got 14 years. If I wait one more year, I'm going to get $15,000. So Of course, when you became highly compensated, then that could be an issue. So we designed a non-qualified plan for highly compensated employees. Those plans could have a lot, they could vest over a longer period. The amounts could be any amount. So we had really a lot more flexibility in this case, but it could only work for highly compensated employees. The moral being, think about qualified plans because it may get you where you want to go, even though it's not your typical 401k and match and everything else.
So Deb, just as a clarification, you and I were talking earlier about what is that level for determining highly compensated employee for 2020? What is that level?
So that amount is an earnings of $130,000 a year.
So it's a pretty substantial number. Your non-highly compensated would cover a lot of ground of middle managers and down to your regular employees.
Right, and this was actually a client that was in some kind of construction work, and so most of their workers were non-highly compensated. But because it was such hard work, they found that turnover was high, and that's why they wanted to have some kind of a plan to retain them. And I think we were able to do that. Okay, so this one is an interesting one. The IRS issued a private letter ruling. Of course, only the taxpayer who got the private letter ruling can rely on it. But what it basically said is, we're sorry, all you people that have to pay off your student loans. And we know that because you're paying your student loans, you can't save in the 401k plan. We're going to make an employer contribution to the 401k plan if you, in fact, can document that you're paying off your student loans. So you're not going to miss out on the match that everybody else gets for contributing to the 401k plan, because we're going to give you money if you pay off your student loan. This is lots and lots of people loved this ruling, and they want to apply it. IRS is now going to issue a higher level of regulatory guidance. They're going to issue us a revenue ruling that's going to outline, hopefully a revenue ruling, maybe they'll put it in regulations, but I doubt it, that's going to outline how you can do this so that more people can adopt this kind of plan. Also, maybe more on the bad side of what's going on with retirement plan audits. Missing participants. IRS and DOL are all over this missing plan participants because there's a lot of money in qualified plans, and nobody knows who. They know who it belongs to. They don't know how to find that person, and that person doesn't even know they have the money. So they have detailed a bunch of ways that you need to go around looking for missing participants, and DOL particularly comes in and audits to find out how, in fact, you are looking for missing participants. You have to go through the plan records, the employer records, public records, Google these guys, see if you can find them on LinkedIn or Facebook or anything. Commercial locating services maybe will have to be used. Certified mail to the last known address. Emails, what's the last email? Can you prove that you've been sending emails to these people and they're not responding? But there's a big push to figure out where these people are so they can get their money, and the push is on the employer, or is on the plan, and then, of course, by extrapolation onto the employer. The IRS issued the first piece of guidance on this, and basically what they issued was a revenue ruling that says if you send somebody a check out of the qualified plan, that amount is taxable retirement plan distribution, even if that check isn't cashed. So this is not a particularly favorable ruling, but I would tell you that people that work in the area, it was not a surprising ruling at all, because that money is available. You can't just choose to leave a check uncashed and not have taxable income. And then we've had some guidance, 403B compliance. There's a big push on 403B because universal availability rule, which is a rule that only applies to 403B plans, IRS finds it often violated, and so they're examining to make sure it isn't. The next one deals Revenue Procedure 2019-39. That deals with a corrections program to let you amend a plan. 401(b) plan retroactively for compliance with the rules. The 2019-19 revenue procedure is the one that applies to the voluntary correction program for operational errors. In the next, the IRS did loosen up that more errors can be corrected with plan amendments under that revenue procedure I just mentioned, 2019-19. And here we have a lot of rules on the definition of compensation and plan eligibility. And then, of course, we have some changes in the law with respect to hardship distributions. So there are required amendments for the 2020 plan year. And there are still some things that you can put in, but they have really loosened up when people can get hardship distributions, specifically that you can't suspend anybody with 401k deferrals. You can't require them to take loans first. They can come from lots of different money within the plan. And then there's some elimination of the financial service facts and circumstances to determine financial need. So those are plan amendments that you need to look for at least by the next plan year.
Great. Well, let's pause here and have our next attendance question. Chrissy's got that open for us. So if you'll make record here of attendance. So Deb, sounds like there's a number of plan changes that need to have been taken place and plans looked at, particularly the 401ks and those deferral type plans that have loosened up the requirements when it comes to hardship distributions. With all the wildfires and floods and hurricanes and things of that sort, 401ks are becoming a place that employees can tap for funds when they get into financial difficulties due to these natural or other disasters.
Right. So those are things we need to look at our plan and make sure we're in compliance with. The hardship rules that are the big ones.
All right. Well, we'll leave that up. The attendance verification open for just another minute. And we will make sure everybody has a chance to respond to that before we move on to talking about things going on within the IRS and to watch out for. So that will be our next topic that we move to. Okay, I think everybody's had a chance to register their attendance.
Okay, so the next one is very interesting, reporting and withholding. So the supplemental wage withholding rate fell from 25% to 22%, and that's for supplemental wages up to $1 million. And people don't think that 22% is high enough and don't actually like paying taxes in April. They'd rather have it subject to withholding. So what you can do is submit another W-4. And of course, maybe I should pause here and tell everybody, there's a new W-4 for 2020, and a lot of people will want to submit a W-4 to get their withholding correct. But here, the way the W-4 works is that you submit it, and it applies to all amounts. And then, so if you want a higher tax rate on your bonus, your supplemental wage, you can put it on the W-4, but then you have to submit another W-4 and adjust the payroll systems. And of course, employers don't like doing all of that. Employers just like to take 22% and be done with it. So a lot of questions we get on, can I get additional withholding? And the answer is yes, only through the W-4 process. And then the next question is, what is the penalty? Well, there really isn't a penalty, but I can't tell you that you can do it. In fact, the IRS in an information letter has told you that overwithholding is not permitted and therefore should not be occurring. Let's move on to the meals provided for the convenience of the employer. I put this in here. It's a technical advice memorandum. It's quite long and it's very good. It basically explains when meals provided on the employer's business premises, whether they're subsidized or without charge, are going to be taxable to the employee. In this case, a technical advice memorandum is when an IRS agent goes in and examines something and the taxpayer and the agent can't agree on what the tax rules are, And so they asked the Chief Counsel's office what those rules are, and a TAM, Technical Advice Memorandum, is issued. And basically, under these facts, the taxpayer said, well, we have to have our employees eating in our employee cafeteria because it promotes collaboration, it protects sensitive information, our employees are safe, they don't have long enough meal times. And IRS basically walked through all of those rules and said that this taxpayer didn't provide any documentation that any of this was occurring. So what you have to do, in fact, they did get a few employees, if you had to be on call and they had documentation that people were called. So the key here is, if you're trying to exclude meals under the meals provided for the convenience of employer rules, you have to have documentation on why it's a critical need. And the other interesting thing in this is that employee snacks were deemed to be de minimis fringes. So we don't have to worry about whether the Coca-Colas are going to be taxable. Coca-Colas free in the break room are going to be taxable or not. Okay, the next thing I stuck in here because this is still a problem. Since 2002, the IRS issued a revenue ruling, and what some people are promoting as a way to save employment taxes, FICA and Medicare, is that you go in and reduce your salary to save all taxes. You're reducing your wages under a cafeteria plan, and then you get those payments made back to you tax-free. And that just it doesn't work. You can't reduce your wages for a cafeteria plan contribution and then pay an amount back that's going to end up being tax-free unless it's a health benefit. And these aren't health benefits in most cases. So the IRS has looked at three. These are called Chief Counsel advices. This, again, is advice to everybody that IRS has seen this scenario. Here's how it works, and here's why the amounts are still taxable. So if you have somebody, and the way I've seen it most recently is that the IRS is treating this as a tax shelter. They're going to the promoters that promoted these products and getting their client lists, and then they're auditing the clients. And where we have been able to help clients is by reducing the amount that would be taxable, by getting into the weeds and understanding exactly how this worked, which is more than what the Internal Revenue agent did. But beware of things that seem too good to be true. The next thing I want to talk about are the ACA penalty letters. These are letters that shock everybody because they're usually six figures, and they basically say, here's your employer shared responsibility payment. It's a very detailed assessment. It tells you exactly what employees didn't have insurance and why there is an assessment. And usually what happens in almost every case I've ever seen is that the information provided to the IRS on the Form 1095 back in 2016 is the year the letters are going out for now. It was 2015 a few months ago. But it's almost always that the information wasn't correct. And all you have to do really is send the correct information back to the IRS. And the IRS, when you talk to them, they don't want extra information. They don't want long letters explaining everything. They don't even want documentation that what you're saying as you correct the form is correct. They just want the corrected form submitted under penalties of perjury, and that usually eliminates the penalty. So, and mistakes get made for a lot of reasons, not the least of which the form was new and people really didn't know how to fill it out. So let's go from there to, can partners be employees? We still see this, but not quite as much. Partners cannot be employees. They need to be issued a K-1 from the partnership, where their salary being paid as a guaranteed entity, as a guaranteed payment. Sometimes we have PEOs, the professional employer organizations, who say, well, I can make them an employee of the PEO, and therefore they can get tax-free health benefits, and they don't need to be treated as a partner. But the statute for certified PEOs and the CAA for all PEOs basically says that you can't convert from a self-employed or a partner status by going to a PEO. So in that case, and you need to be treated as a partner. Now, there are ways. So the big risk is that FICA tax is not the same as self-employment tax. So if you're treated as an employee, you're paying FICA tax, but that means the individual who's self-employed is avoiding SECA tax. And the IRS, there are two different taxes. The IRS says they will offset them, but I wouldn't count on that because they're two taxes. The other real reason that people say is if you put these partners in a 125 cafeteria plan, that taints the entire plan and causes all employees to be taxable on all their salary reduction. So this really is something, I don't like the rule better than more than anybody else does, but it's something that you need to pay attention to. And we show here two ways that you can, in fact, structure the arrangements so that you can satisfy these rules. The first is a tiered partnership structure where we have a partner in Partnership 1 and he works for Partnership 2. Of course, we have to have a partnership in Partnership 1, so we can't have a disregarded entity. That's why you need a 95 and a 5%. But that's one way you can structure it. The other way is that you could structure with an S Corp owner and then have an S Corporation between the partnerships and then be employed by the partnership at the lower tier. So IRS specifically said we're not dealing with tiered partnership arrangements, and that's why the tiered partnership arrangements, until we have future guidance, are ways to restructure around this problem if you really want to treat partners as employees. And I don't expect the IRS is going to issue anything on this for quite some time because it was so controversial when they issued it. Which brings us, I think, to...
Yeah, before we start this, Deb, let's go ahead and get our last polling question in just to make sure that we wrap up on time here and get everybody in to get their last 10 minutes. So, Deb, we've seen that come up frequently, and the question has come up again with 199A, and now I think a lot of partnerships are looking for ways to create W-2 wages in order to allow for partners to be able to take advantage of the 199A deduction on their own individual returns. And this is a way that lower tier partnership can generate some W-2 wages to go along with the income earned. So definitely something to consider. Another reason to consider this besides the prohibition of having partners as employees, but it's a way to create that W-2 wage, which could be very valuable in implementing the Section 199A deduction. Great. All right, one more minute here to get that last poll, and we're ready. So, Deb, we got about 2 or 3 minutes left. You want to talk about these closing agreements and how they work?
Yeah, so the IRS in the Internal Revenue Code, there are provisions that you can go to the IRS and ask for a closing agreement. A closing agreement is basically a letter you send to the IRS and say, look, I made a mistake. I want to come forward and pay the taxes that I owe, and please don't penalize me. And within the employment tax arena, there are actually closing agreement programs that have specific rules as to how you do this. There are, in fact, 2 programs. There's the Voluntary Classification Settlement Program, and this is used when you misclassify an individual as an independent contractor and they should really be an employee. This is a very favorable program, settlement program, because the amount of you have to apply to the form and be accepted, but you will be accepted assuming you're not under examination and a few other rules, which we could go through if you think it applies. But you avoid unemployment taxes, you avoid interest and penalties, and the amount you have to pay is about 10% of what you would otherwise have to pay on some already reduced rates. So the biggest example I can give you is for a client that had this issue, and when we looked at all the individuals that were subject to it, the penalty for 3 years was over $900,000. They went into the program, and the user fee they had to pay was $37,000. So the amount you pay to get through this program is really very low. And therefore, it's something you should pay attention to if, in fact, you have a lot of people that you think might be employees, and yet you're treating them as independent contractors. The other one is the voluntary closing agreement program, and this is where you have incorrect form W-2s. This often happens because employees, there's a small amount that somebody forgot to put on the W-2, maybe a safety award, maybe a Christmas bonus, something that's usually paid outside the regular payroll system. Now, the benefit of this is employees can avoid amending their individual income tax returns, although in most cases you are going to have to give them a W-2C. And that's because the W-2C, if there's adjustments for FICA and Medicare, they need to know what their FICA and Medicare wages are. So I think the last two slides we could quickly look at, which are the examples, was the overseas college instructors. And in this case, the employees had already filed an SS-8 with the IRS and been determined to be employees, and yet we could still voluntarily reclassify them, and the amount was a very small percentage. And then another one was where we had government contractors training military personnel in local culture. In that case, it was some of these individuals were in fact independent contractors and some weren't, and we could draw a line between the types of work that people were doing. And on the taxable events, we had housing allowances for overseas assignments that was a big number that somehow did not get included, although there was a 9/11 exclusion. I mentioned safety awards, personal use of a company car. Oh, this is another one we see. Overseas employees who get reimbursed for their children's educational expenses, group term life insurance premiums that aren't calculated properly, and of course our favorite is wellness payments here, and relocation expenses.
So Deb, both of these seem like good plans, particularly with the heightened awareness and the cases going on by the states to classify those contract employees such as Uber drivers and gig workers as employees and not as independent contractors. We haven't seen that on a national or a federal level, but I well imagine that the fight is going to come the more the way things are going.
Right.
All right, I think that is down to our last slide. Deb, thank you very much for your insight and information today. I don't see any questions in the question pod at this time, so thank you all for your attendance, and we look forward to having you visit with us on another webinar. You have Deb's information here. If you have any follow-up questions, please reach out to her with an email or reach us at Cherry Beckert, and check out our website at cbh.com. for other information, particularly geared towards year-end planning as we're looking towards the end of 2019 and rolling into 2020. Thank you all, and that's all for today.
Thanks, Sarah.